Hey guys, this is going to be lecture 1 for our NOCTI prep. I'm going to do my best to cover a wide range of topics today. And there is a kind of a blank note sheet on Canvas. If you want to follow along, maybe you can somehow get that document onto your iPad and write on it as we go through a couple of different things here from Accounting 1. A lot of it should be review. Some of it might be a little bit fresh. Some of the things that I might have just glossed over during the semester. Now I'm going to get into a little bit more detail on it. And so I want to talk about some accounting principles that remain true whether you're in the US or abroad, right? And so one of the things right off the bat that I want to make sure that has stuck in your head is when you talk about accounting principles in the US, we're talking about GAAP, all right? So we're talking about generally accepted accounting principles. And we're talking about international standards. It's known as IFRS, which is International Financial Reporting Standards. All right, so there are 3 ethical principles that all accountants should follow and keep in mind. We have maybe briefly discussed them before, but now we're going to look at them in more detail. These are principles that should stay with you throughout your career. The first principle is confidentiality. Confidentiality means keeping financial information private. Think about the medical field. Medical providers have laws and regulations requiring them to keep patient information private. You've probably heard of HIPAA before. Accounting has a similar ethical responsibility. As accountants, we follow a professional code of ethics. One of the most important parts of that code is confidentiality because accountants have access to private financial information, including birthdays, social security numbers, addresses, salaries, and tax information. Accountants have a tremendous amount of sensitive information available to them. Even if there's not a formal law covering every specific piece of information you encounter, you are still expected to follow this ethical code. While companies may have employee handbooks explaining what employees can and cannot do, accountants are held to a higher professional standard than that and extends beyond company policy. This is similar to the medical profession. Medical professionals do not only follow the ethics of the hospital where they work, they follow the ethical standards of the entire profession. If someone on a plane needs medical assistance, a doctor may help even though they are not on the clock or at their workplace. They are responding to their ethical expectations of their profession. Accountants are held to a same kind of higher standard. We must maintain confidentiality when handling information that other people are not authorized to know. That means avoiding discussions about confidential information with family or friends. Information learned at work should not become dinner table conversation. If you know someone has lost their job before it becomes public information, you still have a duty as an accountant to keep that information confidential. The second ethical principle is conflict of interest. As an accountant, you should avoid situations where your personal interests interfere with your professional responsibilities. A conflict of interest occurs when personal interests could influence your professional judgment. For example, suppose your firm assigns you to audit a company in which you or your parents own stock. Even if taking the audit would help you professionally, you should remove yourself from the situation. Nobody may ever discover the connection, especially if the stock belongs to your parents, but you still know the conflict exists. The concern is that you may have a personal incentive to avoid reporting problems during the audit because negative audit findings could lower the company's stock price. That personal interest could interfere with your professional duty to remain objective. Some situations are obvious conflicts of interest, while others are more complicated and fall into gray areas. As accountants, we should avoid even the appearance of a conflict of interest. Integrity ties this all together. Integrity means being honest and doing the right thing, even when no one is watching, and even when it comes at a cost to you personally. So, at the beginning of the course, I said that the entire accounting profession and the entire accounting industry depends on one thing: believability. If people cannot trust accountants, then the information accountants provide becomes meaningless. Financial reports must be accurate, trustworthy, and timely. The accounting profession depends on credibility, and credibility depends on integrity. Accountants must do the right thing regardless of personal cost or whether anyone else notices. All right, so those are the three principles that I want you to make sure that you're aware of and you understand what they mean and what all it entails. All right, so confidentiality, that means keeping private information private. Conflict of interest, that means don't put yourself in a position where you have a professional duty that conflicts with your own personal interest, or personal interest that conflicts with your professional duty. And then integrity, tying that all together. Make sure that you're above board on all your transactions. You have a higher call than just what your employee handbook says. You have a duty to the industry, to the profession. And that higher call, that higher order, you have to maintain it in order for the industry to continue and be successful. All right, so next I want to move on to the accounting cycle. All right, and so the textbook has a great summary of the accounting cycle. And this is going to change occasionally depending on the textbook that you're looking at. It might look a little bit different. They might add a couple of steps in there. But generally, the one in the textbook covers the main parts of the accounting cycle that you need to be aware of. And so I'll try to put a image of this on Canvas for you to also take a look at. But the next thing I want to talk about today is the is the accounting cycle. And so the first step in the accounting cycle is analyzing your source documents. Or analyzing your transactions. Source documents include things like receipts, invoices, and bills. These documents provide proof that transactions are legitimate and belong in the accounting system. They show that transactions are not fictitious or fraudulent. Remember, source documents are the first part of our audit trail for making sure that we're only putting business transactions into the business accounting system. Whenever a transaction occurs, such as a sale or purchase, there is usually a source document attached to it. During analysis, we determine which accounts are affected by the transaction. Once we identify the affected accounts, we record the journal entry by debiting one account and crediting another. This process follows double entry accounting. So remember, for every transaction, you're going to have an equal debit and credit. Double entry accounting means every transaction affects at least two accounts, and that the total of the debits must equal the total of the credits. This system keeps the accounting equation in balance. Remember, the accounting equation, assets equals liabilities plus equity. Double entry accounting creates a reliable audit trail and ensures the accounting equation remains in balance. Every transaction must preserve the integrity of the equation. For example, if a company buys supplies on account, supplies increase, which increases assets. Because the purchase was made on account, accounts payable also increases, which increases liabilities. Both sides of the equation increase by the same amount, so the equation stays balanced. The second step in the accounting cycle is journalizing the transaction. After analyzing source documents and determining the debit and credit effects, the transaction is recorded in a journal. Transactions can be recorded in several different journals. At the beginning of the school year, we use the general journal as a catch-all journal. Later, we introduced special journals which reduced the time required to record transactions and helped us minimize errors. When journalizing transactions, remember the source document column. This column helps create an audit trail by showing that a source document exists and when it analyzed before and was analyzed before the entry was recorded. The third step is posting transactions to the ledger. I know for us, a lot of the times what we did is that we journalized every transaction for a month. And then after that, we went to the next step and we posted all of those transactions for the month. But in reality, what would make more sense if we were using that type of system is that once we journalized it, we would immediately post it. But when you think about accounting systems today, there's not people sitting somewhere posting a bunch of journal entries. There's just a button, or the system automatically is posting when the journal entry is recorded. All right. So that whole cumbersome process of posting that we put ourselves through this semester, it's not the reality of the accounting field or what accountants do on a day-to-day basis. The system is automatically posting this as those transactions are journalized. So step 2 and 3 in reality kind of go hand in hand, because once step 2 happens, you can make the assumption that step 3 is happening concurrently at the same time. All right, so every account has its own ledger. Posting to the ledger continues the audit trail because each journal entry is transferred to a corresponding ledger account. The posting references connect the journal and the ledger together. For example, a transaction from General Journal page 13 might be referenced as G13. The ledger points back to the journal entry, and the journal entry points to the ledger account. After analyzing source documents, journalizing transactions, and posting to the ledger, step 4 is preparing the worksheet and trial balance. Remember, the worksheet is not part of the permanent records. It functions as the accountant's scratch paper. The primary purpose of the trial balance is to verify that debits equal credits. If debits and credits do not match, an error occurred somewhere during journalizing or posting. At that point, the accountant must review the financial records to locate and correct the mistake. After preparing the trial balance, the worksheet is used to determine which adjusting entries are needed to update the account balances properly. Adjusting entries are required to comply with accrual accounting. Accrual accounting is required by GAAP, or generally accepted accounting principles. Under accrual accounting, revenue is recorded when earned and expenses are recorded when incurred, not simply when cash changes hands. This approach gives a more accurate picture of the company's financial activity. Sales should be recorded when they occur, and purchases made on credit should also be recorded in the period in which they occur. This follows the matching principle, which requires revenues and expenses to be recorded in the same accounting period. The purpose of adjusting entries is to ensure that revenues and expenses are recorded in the correct accounting period according to GAAP. Examples include prepaid insurance, supplies, interest revenue, and interest expense. These items may be accrued even if cash has not yet been paid or received. A good example of an accrued expense is payroll. Employees may work through December but not receive payment until January 15th. The salary expense still belongs in December because that is when the employees earned it. The expense should be recorded in December, even though the cash payment occurs later. Adjusting entries ensure that the income statement and balance sheet accurately reflect what happened during the accounting period. Another example is prepaid rent. Rent paid in advance is initially recorded as an asset. As time passes and the benefit is used, part of the prepaid rent is moved from an asset account to an expense account. After adjusting journal entries are completed on the worksheet, the amounts flow into the income statement and balance sheet columns. Step 6. All right, so step 5 was your adjusting journal entries. And step 6 is preparing your financial statements. So in the last chapter, we added another financial statement, the statement of cash flows. Unlike the other statements, the statement of cash flows follows cash basis accounting rather than accrual accounting. The primary financial statements are the income statement and the balance sheet. The income statement contains temporary accounts, including revenues and expenses. Those temporary accounts are also known as nominal accounts. All right, so nominal and temporary accounts, those are synonymous. Your nominal accounts are your temporary accounts and vice versa. Those are your income statement accounts. The balance sheet contains your permanent accounts, including assets, liabilities, and equity. Those permanent accounts are also known as real accounts. All right, so permanent accounts and real accounts are synonymous. Those are going to show up on your balance sheet. Additional financial statements include the statement of cash flows and the statement of stockholders' equity, which focuses specifically on the equity section of the balance sheet. Overall, we prepared 4 financial statements. All right, so those 4 financial statements that we prepared were the income statement, the balance sheet, the statement of cash flows, and this is the one that we just did. Remember, the statement of cash flows is the one that is on a cash basis of accounting. All your other statements were on the accrual basis. And then the statement of stockholders' equity. So you should be able to solve for missing values using accounting formulas. For example, if you know assets and liabilities, you should be able to solve for equity using the accounting equation. And there are some other equations that you should also know, because you want to make sure that you know how to calculate net income. All right, so net income equals your gross profit minus your operating expenses. All right, so your net income equals your gross profit minus your operating expenses. So net income equals gross profit minus your operating expenses. To calculate the gross profit, you take your sales revenue minus your cost of goods sold. All right, so your gross profit, how do you calculate your gross profit? Your gross profit equals your sales revenue minus your cost of goods sold, or your cost of merchandise sold. Now, one thing that I want you guys to be aware of is that whenever we talked about a revenue account, it was called sales, right? But there could be another term for these revenue accounts, all right? And they may call them something like legal fee income, all right? So say that we're a law firm and most of the income that we have is from people paying legal fees. So the name of the revenue account might be called legal fee income. And it may not have income on the end of it, right? So you might have to make the assumption that if you see something that says legal fees, or you see something that says there's a lot of different, I guess, ways, depending on what the business is, doctor fees, dental fees, those might be your revenue accounts or income accounts. Now, if they are expense accounts, they should have the word expense attached to the back of it, right? So it should say something like legal fee expense, then you know it's an expense account. But if it just says something like dental fees or legal fees, it is likely a revenue account. So that's something I want you to be aware of, because that's not something we saw in the text that we were using. All right. So sales revenue, AKA, could be called sales fees. All right. I want you to be aware of that going into NOCTI. All right. So once gross profit is determined, you could subtract your operating expenses to calculate your net income. All right. So going back to the accounting cycle here, step 7 on your accounting cycle is closing your temporary accounts. Closing your temporary accounts. All right, and so there are 4 main closing accounts, and closing entries reset your temporary accounts, such as revenue and expense accounts, basically setting them back to 0. All right, so your nominal accounts, your temporary accounts, your income statement accounts, you're setting them back to 0 when you do your closing journal entries. Now, if you guys remember our expert in closing journal entries, you pull up, right? His name was Reid, REID. And that's a way to remember your 4 closing journal entries, right? So the first thing that you want to close is you want to close all of your revenue accounts and set them back to 0. So you're going to close your revenue accounts, and you're going to close them to an account called income summary. Remember, income summary is that account that goes both ways, does what we need it to do, shows up when we need it, and then we just forget about it until we need it again, right? And then you're going to close your expense accounts. And so you're going to close all your expense accounts, and you're going to close them to income summary. At this point, the balance of your income summary account should equal your net income or your net loss. All right. The balance of your income summary account should equal your net income or your net loss after your first 2 closing journal entries, after you've closed revenue, after you've closed expenses. Now, one thing to keep in mind is that there might be one other journal entry that's in that income summary account. Does anybody remember what that is? As far as closing journal entries, we know that we're going to close all of our revenue accounts by debiting them. So that means that when we close our revenue accounts by debiting them, they are going to be a credit to income summary. And then we close all of our expense accounts by crediting them. That's going to be a debit to income summary. And then we're either going to wind up with a balance that represents income, which would mean that our revenue exceeded our expenses, or it's going to wind up with a situation where we have a net loss, where we either have net income or net loss. Now, the only other thing that could be up here, and that could be an adjusting journal entry, all right, in your income summary account, is the adjustment to merchandise inventory. All right, so once you've made these 2 closing journal entries to close your revenue accounts, to close your expense accounts, the only other thing that could have been in income summary is your adjusting journal entry to merchandise inventory. At the end of the day, though, your balance in your income summary account should represent either your net income or your net loss. And that's what your 3rd closing journal entry is going to be, is to close your income summary account. And you're going to close your income summary account to retained earnings if it's a corporation, Or if it's a sole proprietorship, you'll close it to the capital account. All right. So once you close this income summary, you're basically recognizing either net income or net loss for that period on your third closing journal entry. When you close income summary and set it back to zero, you're essentially booking that net income, or you're recognizing that there was a net loss for that period, because you're either going to be increasing retained earnings or decreasing it, increasing capital or decreasing it with a sole proprietorship, or here with a corporation. All right, and your final closing journal entry is to close your drawing account or your dividends account if it's a corporation, and you're going to close that to capital if it's a sole proprietorship, or you're going to close dividends to retained earnings if you're dealing with a corporation. All right, so those are your 4 closing journal entries: close revenue, close expenses, recognize your net income or your net loss by closing your income summary account, and then finally close your drawing or your dividends account to your equity account, which is either capital or retained earnings, depending on whether you're dealing with a sole proprietorship or a corporation. All right, so then after your closing entries are created, your next step is going to be to prepare your post-closing trial balance. And the post-closing trial balance, it verifies that all your permanent accounts are recorded correctly and that debits still equal credits. It confirms that the accounting equation remains balanced after all closing journal entries have been made. The post-closing trial balance contains only permanent accounts, your assets, your liabilities, and equity. All right, so that means that all your temporary accounts should already be closed, your revenue and your expenses. All right, so that's a good portion of what I wanted to talk about. The last thing that I want to cover today is depreciation. All right, so far today we talked about GAAP versus IFRS. Remember, GAAP is followed in the US, IFRS is followed everywhere else, most everywhere else. We talked about 3 major accounting principles, just like from an ethical standpoint for accountants, that we must have to and we must follow and keep ourselves accountable for, no matter what company we're working for, in order to protect the profession, protect the industry: confidentiality, keeping private things private, conflict of interest. If there's even an appearance that your personal interest might conflict with your professional duties, step away from it. All right, make that known. If you're on a team and you're going on an audit and all of a sudden you figure out, like, oh, I know this person that works for the other company, they're my uncle's wife or whatever, or my uncle's best friend, you need to make that known to the people that you were, hey, you know what, I might have a conflict of interest here. That person is, really close to my uncle, or whatever it might be. Integrity, wrapping that all up, just make sure, even if it comes at a personal cost, if that means that you end up losing your job, all right, even if nobody's going to know, even if nobody's ever going to find out, all right, integrity, make sure you're always doing the right thing. We talked about the accounting cycle. We talked about the 8 steps of the accounting cycle. All right. We took pauses in between to talk about different formulas like net income, gross profit. We talked about the 4 financial statements that we created: income statement, balance sheet, statement of stockholders' equity. Remember, the statement of cash flows is the only statement that we created using the cash basis of accounting. Otherwise, we're following GAAP and we're using accrual accounting, which basically means that we recognize revenue when it's earned and we record expenses when they are incurred, right? We talked about the adjusting journal entries, closing the temporary accounts. Remember, READ helps us remember how to close our accounts, and then preparing the post-closing trial balance. Remember, temporary is the same as nominal, all right? Permanent is the same as real accounts. All right, your real accounts are your balance sheet accounts, your assets, liabilities, equity accounts. Your nominal or your temporary accounts or your income statement accounts, your revenue, and your expenses. All right. So the last thing that I want to talk about today is depreciation and the different methods of depreciation. Remember, depreciation is the loss in the value of an asset over time. And so the different depreciation methods that we studied were one, we studied LIFO. And we talked about LIFO, which stood for last in, first out. And if you remember, for last in, first out, I drew a picture of a sand pile or a dirt pile. And the bottom of that pile represents the inventory that we received earliest. And the top of the pile represented the inventory that we had most recently received. And so LIFO is saying that the last inventory we received is the first inventory that's gone out. And we also talked about FIFO, which stands for first in, first out. And the example that I gave for this was milk, right? We want to make sure that the inventory of milk that we've received first is the first inventory of milk that goes out because milk spoils. Now remember, according to GAAP, it doesn't matter if it makes sense or not for the type of inventory you have. So even if you are only selling milk, you can still use the LIFO method of inventory. All right. These were just examples that I gave you to help you remember what each of them meant or stood for. The third one was weighted average. And remember, the weighted average method of depreciation just takes all of the inventory and assigns an average cost of that inventory to value your ending inventory. And then finally, the most conservative method is the lower of cost or market. And the lower of cost or market is the most conservative approach to valuing your inventory. All right, so LIFO means the most recent inventory purchased is sold first, leaving older inventory remaining. So when we talked about last in, first out, we also basically said that means the first in is still here. So when we're valuing ending inventory with LIFO, we remember that the first in is still here, LIFO fish. With FIFO, it means the oldest inventory is sold first, like milk rotating through a grocery store refrigerator. Under FIFO, the newest inventory remains on hand. So when we talked about FIFO, first in, first out, what that means is the last in is still here. So when we're valuing ending inventory, that means the last in is still here. The weighted average method calculates inventory value using the average cost of all of the units. And the lower of cost or market, which is required under IFRS, and so the international financial standards require the lower of cost or market, the inventory is valued at whichever amount is lower, the calculated inventory cost or the current market value. And so LCM is considered the most conservative inventory valuation method because it helps prevent businesses from overstating their assets, especially when inventory may have lost value. All right, so those were the 4 different depreciation methods that we talked about in class. I'm sorry, not depreciation methods. I've been saying depreciation methods this whole time, and I didn't mean to do that. I should have been saying inventory valuation methods. All right, so these are different inventory valuation methods that we've been using in this class. And so at some point, I do need to talk about depreciation and depreciation methods. That's the loss of a value of an asset over time. But that's not what I was talking about here, even though I kept saying depreciation. What I meant to say was inventory valuation and how we value our inventory over time. There's a couple of like conceptual things that I just need you to memorize is that typically during periods of inflation, that means when prices are going up, which is the norm in most economies, right? So during periods of inflations, which is the typical movement of prices in a healthy economy, when you talk about LIFO is going to give you, last in, first out, is going to give you the highest cost of goods sold. All right. That means that the FIFO method is going to give you the lowest cost of goods sold. All right. So, what that translates to is if during periods of inflation, LIFO gives you the highest cost of goods sold, that means it's going to give you the lowest gross profit, which then translates to the lowest net income, which then translates to the lowest tax liability. Under periods of inflation, FIFO is going to give you the lowest cost of goods sold, which is in turn going to give you the highest gross profit, which then gives you the highest net income, which then gives you the highest potential tax liability. Now, sometimes that doesn't matter because the IRS rules are going to trump whatever inventory valuation that you're using. But those are things that I just need you to commit to memory, is that during periods of inflation, you're going to have the highest cost of goods sold with LIFO because you're saying that you're selling the most recent inventory that you received, and the most recent inventory that you received is going to be the highest priced inventory. And so with FIFO, you're selling the oldest inventory that you received, which would be the lowest priced inventory that you purchased. And so it's going to give you the lowest cost of goods sold and the highest gross profit. So during periods of inflation, that's the key point, all right? So which is the norm for most economies, is that during periods of inflation, that means prices are going up. LIFO is going to give you the highest cost of goods sold. FIFO is going to give you the lowest cost of goods sold. All right, so that's all I have for today. We'll continue talking about NOCTI topics over the next few days, and we'll have some additional review sessions. But in the meantime, be sure you're looking at those things that are on Canvas and practicing with them.